wanted to just frame the conversation today. 2018 turned out to be quite an active year in structured finance markets with over $1 trillion equivalents issued across the globe, representing double digits on a year-over-year basis. Following a strong Q1, securitized credit fundamentals appear to be on strong footing. The ABS and RMBS markets have benefited from tighter labor markets and a meaningful consumer deleveraging since the financial crisis. The CMBS market also retains positive tone and continues to grow stronger. There's been an increase in demand for bonds across the CMBS sector, which is attributable in part because of the flip of the calendar and some fairly typical quarter-end pressures that often reduce liquidity. And some say Q1 total return performance in CMBS was the best since 2012 in both an absolute and excess spread basis. So this will be our focus today. The securitized market, the strong performance in the sector, the opportunity for investors, and how politics might change the landscape once again. So with that, I want to turn the conversation over to the experts for introductions. TJ?
Sure, thanks, Alex. My name is TJ Durkin. I work at Angelo Gordon, where I've been for 11 years. I run the residential mortgage and ABS business, where we manage about $4 billion of the firm's $32 billion of capital.
My name is Matt Miller. I work at Bayview Asset Management. I've been there about 7 years. Bayview is a $14 billion asset manager that started in '07. But prior to that, Bayview was actually one of the largest purchasers of distressed residential loans and one of the largest originators of small balance commercial loans, businesses that it still has today, and has the servicing capability in both spaces.
I'm Chris Hentemann. I founded 400 Capital. We're a $2.6 billion manager that focuses on securitized and structured credit opportunities from across the spectrum, from mortgages, residential mortgages, real estate, consumer, and corporate-related credits. Thanks for having me.
Of course. So, gentlemen, let's start out with the U.S. housing market in the context of RMBS, and maybe, Chris, you want to take lead. In 2018, the U.S. housing prices rose roughly 5 to 6%, which is the 7th consecutive year in a row, with home prices projected to mirror the U.S. economic growth, which is robust at the moment, and a favorable supply and demand dynamic leading projection of U.S. housing growth to be between 3 and 4% in 2019. How are you positioning your portfolio to take advantage of this opportunity?
Well, we're a big fan of the housing markets, in particular mortgage credit. And then even if I wanted to drop in from a more macro point of view, I mean, there's been a lot of discussion over the last couple of days about credit.
Yeah.
And so one of the things we like to do is sort of break credit down into sort of the different subsectors that I think people tend to miss. So we think about sort of where our biases are, and we tend to be biased towards real estate, and particularly consumer credit over corporate credit. And then if you get into the consumer credit, we like basically the mortgage-related credit for a number of reasons. And one that I think is actually worth consideration is, I like to always say there's actually really good guardrails around mortgage credit origination that I think people underestimate, and it's particularly basically in the wake of what happened in the financial crisis. So regulation has really put significant guardrails that really haven't changed much in the last 10 years. So you get great credit origination, and then you get great consumer credit backing it. And then when you get into it and you talk about housing prices and you talk about the asset value that you're securing yourself against, yes, it's been actually recovering. And if you put it relative to other asset classes, it's recovered really well, but it still hasn't recovered as aggressively as other things like commercial real estate. Commercial real estate's actually probably on a price basis actually been more aggressive in terms of its recovery. And then the nuance I'd add on top of that gets us really excited, which is if you break it into tiers, the lowest tier of the housing market, the sub $400,000, sub $300,000 mortgage or properties have been improving at a higher rate because there's a very significant dearth of available housing. And so what it's done is it's created a floor for prices. And so that supply-demand imbalance has created an above average, about a 200 basis point better HPI result. And so we think a lot about focusing on where credit origination is done really well, where the regulation's been really good. And then two, what we look at is we try to get positioned around lower loan balance and lower price tiers in the housing market, where we can benefit from even a more aggressive rise in HPI values.
Yeah, I would agree with a lot of that. I like to kind of refer to housing as like the least rich of all the asset classes post-crisis at this point. And I think it is really important that all of the regulations have been put into housing, right? One of the things that happened in the previous cycle is that credit everywhere kind of went down. And obviously housing was at the center of that. So as a response, out of the government, out of regulators, has just been like, we're never going to have that crisis again, and has really focused on resi. So when you think about kind of credit cycles, and everybody can talk about corporate credit cycles and even CMBS a little bit, the resi market still feels like it's in the first inning of its credit cycle. And I think that's important for a couple of things. As credit investors as opposed to equity investors, while HPI going down so hard during the crisis led to tremendous defaults, those loans that were made were not well underwritten. I remember people advertising ninja loans, which was no income, no job, no assets. It was literally, do you have title of a house? Here's a loan. That doesn't happen today, which means the response rate in terms of defaults, even if housing were to fall, is substantially better protected today than it had been going into the previous crisis. So you won't see as many distressed defaulters. That won't lead to as much distressed inventory. So even in a downturn that maybe might be triggered by something else in other credit markets, it's not going to lead to kind of a knock-on effect and such a massive overshoot back down towards fair value if it does turn.
And TJ, do you focus on the European RMBS? Do you want to comment on?
Yeah, I mean, I generally, we generally agree with everything these guys said on the U.S. I think we try and look at some other opportunities away from just the U.S. And so, as an example, we've been able to, buy very seasoned mortgages in the UK, where I think there's just a general aversion to people adding risk in sterling. So we're able to, buy mezzanine 10+ year seasoned UK mortgages with a 55 LTV, just because there's not a lot of people paying attention to it. And as Brexit continues to get the can kicked down the road, whenever that eventually happens, we think people that have lived in their house for longer than a decade, have 45 points of equity in their house, should get through whatever that exit looks like, and our credit should be well subordinated and money good.
Great. So moving on to the U.S. commercial real estate market. Matt, why don't you take lead? The U.S. commercial real estate experienced a period of significant growth post-crisis. However, prices have stabilized over the past 2 years and are expected to remain relatively flat in 2019. So commercial real estate conditions remain positive with high occupancy levels, rising rental rates, and a healthy U.S. economy, but a higher interest rate could provide some headwinds for 2019. Do you want to talk about that?
Sure. I mean, that's a perfect setup. You do kind of have a Goldilocks environment for commercial real estate right now, and a lot of that is priced in. So you have low interest rates, which can lead to lower cap rates. One could argue with interest rates this low, there's actually room for cap rates to continue to improve, but they are very low from historic standpoints. And because the economy has done so well, in aggregate, rents are doing very, very well. But just like Chris was talking about different tiers of the housing market, the commercial market has lots of different sub-markets. So there's industrial, there's retail, there's hotel, and one sector that hasn't done well, obviously, is retail. Right. With kind of the growth of online sales really impacting retail, malls in particular, but retail across the board. So it's not totally uniform across what's happening in commercials, and then kind of bringing it back to kind of the credit opportunities, because again, we're buying the debt, not the equity of the commercial real estate, is how tight are commercial loans underwritten today? And the commercial market hasn't benefited from the over-regulation that kind of is benefiting newly originated resi loans. There has been some in terms of risk retention with Dodd-Frank. So if you just think about normal kind of credit cycles, when the commercial market started opening up again in 2011 and 2012, those loans were substantially tighter than anything that was done pre-crisis. And then you kind of saw it start to expand out. But by the time you got to that somewhat credit sell-off with oil and Chinese equities at the late 15, early 16, was right around the same time that risk retention was coming on board, and at the same time that retail was really getting into the zeitgeist. So CMBS is somewhat unique within our spaces that it has a synthetic index, CMBX, and ABX was such a star of the Big Short movie in real life that the CMBX gets attention. Is like, well, if there's a Big Short and if commercial real estate is overvalued and if retail's going down, that's all I need to know, and I'm going to just start shorting all of these levered tranches. But when you kind of look at it in terms of like the retail story and the weak malls, that for the most part occurred in 2015 and earlier stories. And away from the malls in there, the other commercial real estate that was done in those deals has done extremely well. But then when you get past 2016, you had a little bit of a swing tighter in credit. It has been expanding again. The LTVs have been holding in pretty well, but the IO percentages have definitely grown. But again, when you're kind of looking at that and trying to determine whether that's a good short or not from more recent vintage, and you're looking at the IO percentage, that's a 10-year loan, right? So you're really talking about like, when the IO recast or the fact that it's not amortizing, which again is a huge benefit for the resi market, are they going to have problems refining in 10 years? Otherwise, you really have to look at, is it going to lead to defaults early on? And it's a pretty expensive short from a new issue standpoint to carry all the way through.
And I think yesterday in the multi-strategy panel, Josh Friedman from Canyon Partners had mentioned that he was shorting the CMBX. So, kind of focusing on our area. But Chris, I didn't know if you wanted to comment on, having a multi-strategy short the CMBX and your firm doing similar.
One of the nice things about CMBS particularly is you do have an index that's actually traded pretty actively, and so it's liquid enough that you can get in and out of shorts, and so you can express opinions on the short side through the CMBX index. You have to pick your points, and it's a much different short than it is comparing it to AVX, which actually everybody loves to basically highlight as like I found the next big short. As Matt was mentioning, there's some significant differences between the two. Is that if you think about you can focus on retail, but it's hard to get exclusively retail-orientated exposure in a CMBX index. So if your idea, your thesis is I'm going to short retail, there are sectors that have concentrations of retail, but it's not a pure play. We're very close to the retail trade, and we've taken a bearish point of view on it. And what we've done is we've actually gone outside of CMBX and gone to REITs or public equities and other forms of single name credit exposure where we can get short specifically retail exposures. And so if you think about it, we're structured finance professionals, and when I want to actually express an opinion on retail, I'm going to go outside of structured finance and into unsecured corporate or even the equity market to leverage those views. But I'm going to do it in a different market. So CMBX is much more of a I think of a macro short, and I do think that there's some merits at certain levels where it makes sense to get on the short side, and we tend to actually carry CMBX on the short side than the long side. We use it as more of a beta hedge, and then we look for idiosyncratic longs in the real estate market around multifamily, as you're alluding to, which is us just leveraging off of our views of the residential and household formation. Industrial's been great. So there's unique idiosyncratic longs that we look for in CMBS, and then CMBX we use as much more of a beta hedge. And then when we think about really focused nuance, let's say retail-oriented trades, we will probably prefer to go outside of the CMBX market to basically put those types of trades on the short side.
TJ, do you want to get in on this Amazon effect discussion?
No, I mean we're not as active as these gentlemen in CMBS. I mean we're looking at kind of the health of the consumer, and so I think our view is we don't really care where they're shopping as long as they're paying their bills, right? And so if you kind of fast forward that into, I think the theme has been the health of the U.S. consumer, and I think we are very constructive on that. It's sort of the highest ever recorded FICO on average. If you were to sort of break out that into the tiers, I think we look at it as there's the lowest percentage of U.S. Consumers that are deemed subprime, so say 620 FICO or below. So it's a good distribution. It's not just the high numbers pulling up the mean. And so we look for various ways to play that on the consumer, so the consumer unsecured side. So not necessarily just housing, but looking at kind of installment loans, credit card receivables, et cetera.
So you're bullish on the consumer from an ABS standpoint. You're not going to do any short shorting in that area?
No, I think we think there's probably some more legs to sort of the health here of the U.S. consumer. And again, like employment is like the number that I think grabs a lot of attention. But what we've seen in like the last, call it 12 to 18 months, is almost a hockey stick in terms of wages for the lower and medium wage earners. And so they are now sort of participating in the growth of the economy. And it's been a pretty rapid ascent in terms of just hourly wages.
And what about, there's been a little bit of discussion where we're thinking into 2020 and 2021 about potentially a more recessionary environment. How are you positioning for that?
I mean, it's anyone's guess when the next recession is. I think what we're confident on is that it's probably not going to be because of a over-leveraged consumer like we had kind of 10, 12 years ago leading into the crisis. So it could be from, government, tariffs, import, exports, things like that. But I don't think it's going to be caused by U.S. Default cycle on the consumer side.
Okay. So now let's talk a little bit more macro level. I know we've touched on some themes already, but for Freddie and Fannie, when they went into government conservatorships as the housing bubble burst, since then the agency has overseen the GSEs, and there's been a lot of discussion around GSE reform. So I wanted to get the panel's opinion on is it going to be something extraordinary or something notably less?
I think it's a battleship. It's going to be very hard to turn this thing on a dime. There's a lot of discussion about it, and it's been a topic that's been on the stage for years, and it's obviously been in the media, and it's going to take a lot of group effort to move the GSEs out of conservatorship, and right now probably one of the biggest challenges is if it's not broken, why fix it? And so there's a few things that have been going on with regards to risk transfer that have been very good for the taxpayer and for, and for housing that have evolved post-crisis, like all the risk transfer, and we all participate in it, has been, has introduced the private markets into basically taking mortgage credit, and so that's been working really well. And to put it into context, I think I was here years ago, and it was a brand new concept in terms of just credit. Everybody's like, "What's the credit risk transfer market in the housing?" And I used to say it's the new high yield bond market. And it was introduced in 2012, and now we've got over $70 billion of outstanding risk transfer assets out in the market, which cover 1.2 trillion of mortgage origination. So you think about what their role has done, it's actually been, their function has changed in terms of being a conduit to risk transfer instead of basically being a warehouse of that risk. So it's kind of working. There is a policy issue, and I am concerned about it, is that, do they become a policy instrument? And I think that's kind of behind some of the changes. And I do think that, it merits basically some discussion. And Calabria, the new FHFA director, is mandated to basically sort of figure that out. And so I think that's a healthy discussion. I think he's got some tools to basically reduce their footprint and make them less of a risk to policy mandates in the future that may distort what's happening in terms of basically the risk that the taxpayer is taking around housing. So so I do think that basically the discussion is healthy, but I don't think it's going to change anytime soon. It's going to take a while.
Matt, I saw you nodding your head.
Well, I agree. Like, one of the big changes on top of just all the regulation that's occurred, particularly as it relates to the GSEs, is not only are they not taking the same kind of risk in terms of quality of loans that was underwritten pre-crisis versus what's being underwritten today, but there's also been a tremendous amount of private capital that's come in through the CRT market. And I really, nobody in DC is really asking me for my opinion, but I do see the CRT model as really a great model for a lot of markets going forward. Freddie and Fannie are playing a really important role, to me as an investor, in terms of providing standards and enforcing reps, things that kind of broke leading into the previous crisis. Sure. As kind of an investor in the space, housing is such a huge market. Kind of whatever happens in GSE reform, I think there's always going to be an opportunity that's kind of created for investors who understand the space. But I kind of agree, if anything, even without Congress acting on reform, the companies and the FHFA have done a phenomenal job reforming what they do in a way that's way more robust than it's ever been before.
If I
Yeah,
could, I'm sorry to interrupt. One thing to add to that too is like, because you were talking about the CRT as a model, TJ, you may have a comment on this, with regards to the stuff that you're doing in Europe. But one of the things that we're starting to see is we're seeing European banks actually sort of steal a page out of the CRT book, and they're literally doing structures that we've been starting to get engaged in over the last 2 to 3 years. And we're seeing it with the European banks that have like SME exposures and small balance real estate and consumer exposures, and they're actually developing securitized structures where they transfer credit risk. So on that note, I think what you're seeing is actually the same concept. As successful it's been in the U.S., it's actually getting it, I guess, exported to Europe, and we're seeing more of that.
Yeah, we're seeing that too, and I think the simplest way to think of the GSEs is they're just a utility, right? And that even if I think there is private capital that wants to equitize that, but there's always going to be this implicit government backstop, and so the private capital will be raised to kind of get them through, I think, a normal recession or housing downturn. But I don't think there's a vision where the GSEs will be able to withstand kind of a 2008 scenario on their own.
Great. So let's move on to another macro discussion around the softening of Volcker. I don't know if, the rule was meant to prevent lenders from federally backed deposit insurance from suffering these huge trading losses. But some say confusion over which short-term trades pass muster have made banks a little too cautious, so prompting a retrenchment from certain assets that could drive liquidity when markets are under stress. TJ, do you want to lead us off?
Yeah, so I think, at least our view, and when we talk to the investment banks, I actually don't think Volcker is as big of a hurdle as some of the capital rules that the banks have to hold. So when they own inventory or buy bonds from us and position them, the capital rules are more onerous than I think Volcker. I think if you got rid of Volcker, the banks probably save a lot of money on their compliance departments, but the way they interact with us in terms of buying and selling, I don't think has been that impeded, right? And I think there's other things in the market that hurt liquidity, like Trace, and where I've heard kind of anecdotally that in the corporate market where Trace has been forever, I think there's movement to try and delay the reporting. So it's really hard for an investment bank or a broker dealer to buy a bond from one of us, have that print reported to the whole market, and then have them be in a good position to try and make some bid ask. And so maybe like delaying it 2 days or something where they can make some bid ask and kind of maintain liquidity, I think is way more important than Volcker.
Yeah, I would agree. And I think liquidity has probably gotten way worse in corporates versus our markets. But I also find discussions about liquidity, it's somewhat important to kind of define liquidity. I think liquidity has 3 dimensions. One, which is somewhat the most obvious, is if I've got a big position, how much of it can I sell without the fact that I'm selling actually moves the market, which is different than how transparent is the market, and how easy is it to mark. And then the third, which we've been dealing with a lot more since we haven't been in a crisis for a while, is when there's a trade that I like, how easily can I source it and scale it up? And I find if you look at some of our markets, like the legacy RMBS market, from all the markets that I look in, including the equities, is actually the most liquid. I can have a list with 200, 300 million and know that that's not going to move the market. Now, it's also the least transparent and probably the most opaque, that if you're not engaged in the market every day, there's no way you could just kind of look at a bond and figure out where it should trade. So I kind of feel like it's a very liquid market, but very opaque. On the flip side, if you look at on the equity side, like small cap financials, I know every minute of the day where I can sell 100 shares, but I really have no clue where I can move 500,000 shares. So I feel like that transparency, which regulators think equals liquidity, is actually a misnomer. And the same thing with Trace. Before Trace, if I needed to sell 100 million of an ABS bond, I could call up a dealer. They'd be like, okay, here's my quoted market, but for 100 million, I'll be like 3 basis points back. Nobody would know we did the trade, and they could work out of it at the market. Now with Trace, as soon as, they can't really offer me that liquidity, because as soon as they do the trade, everybody's going to see it, and the whole market's going to move down to that level. So the ability for a dealer to offer size behind the market doesn't really exist in all of the markets that are on Trace.
I might have a different take on this, but I agree with everything they said, and I might add a different perspective to it. One of the things that I think has changed in the last, say, 10 years, and probably more importantly, since the first quarter of 2016, we're which I think we probably all agree was probably one of the more, I'd say, technical corrections that we've had in our market, where markets got extremely volatile, and we all realized very bluntly that the market makers that we're really used to really sort of pulled back very aggressively, and so we saw that gap in liquidity in the first quarter of 16. And what I would say is yes, markets are going to be basically susceptible to low liquidity environments. But what I think we've done as basically an alternative asset class, particularly in this particular sector, is we've developed our businesses where I think we're much better at the asset liability management, such that when liquidity gaps, we're not actually sort of desperate for liquidity. I mean, so I think about it as, and I think we all probably share sort of similar platforms, but we run different vehicles. And even in the vehicles that are the most actively traded, the structures of our vehicles are actually very thoughtful around that event. I mean, we model the structures so that they can withstand, those stress events. If we can't get liquidity, can we sustain basically the cash flow needs, the capital needs of our LPs? So our asset liability structuring has been much more thoughtful, and I think that's shared across all of my peer group. And even to a point where, everybody talks about private debt structures and things of that nature, there are some great opportunities in our sector that are, really unique, and they're fantastic risk-adjusted returns, but you got to put them in the right vehicle.
Sure.
And so the ability to actually, where we have LPs now that are really excited about and have the tolerance to go into, like, let's say 5-year to 7-year committed vehicles, those are fantastic, because now you're owning these opportunities in the right vehicle. And actually, in some of those vehicles, they're very opportunistic when the liquid markets, cramp up. And we have some carve-outs to actually to step in with those vehicles and be a provider of last resort for liquidity that the street might not have. So I think we've adapted our businesses is kind of the point I would make, and the vehicle structures for a market that has a little bit of a checkered past in terms of its liquidity, and everybody likes to point to that, but I think we've gotten better about managing the strategies around that.
So I love that you bring up, in the past there was some issues, right, around your areas. But for investors, since I think there are some investors in the audience, how should they be thinking about, securitized products in your portfolios and positioning that, from a diversification angle within their portfolios?
Yeah, I think there's been interest in our product over the last few years in particular. We're in this persistent low interest rate environment. I think people are looking for yield, and I think people are looking for yield in something other than corporates. And so they've naturally sort of gravitated to our space. And, over the last, 3, 5, 7, 10 years, we've just demonstrated a fairly low correlation to high yield and S&Ps. And I think people are using this as a diversifying, part of the portfolio. And we've definitely seen more interest, particularly, within the last 2 years, as I think the crisis somewhat fades and people are starting to accept that it's not the same exact product, it's not the same market structure as Chris talks about, and people are much more receptive.
Matt?
Yeah, I would agree. I think, when you're sitting here, kind of valuations where they are in every market, with corporate underwriting standards kind of obviously being pushed, but no clear catalyst for where that's going to end, being able to find a sector where the underlying credit, at least through a normal recession, is fairly solid and should still generate good returns, as well as kind of a fixed income vehicle that doesn't rely on taking duration when interest rates are already so low. It's a pretty unique asset class within that regard.
Okay.
I actually might give you a slightly different answer again. I think about it very personally. I think about it and say, look, I'm a big fan of the U.S. economy. I think the U.S. economy in the long run is a fantastic place to be invested, and probably one of the best places to do it is in the equity markets. But I'm not an equity investor, and so, but I have to have some allocation to it. So I diversify my own personal portfolio. And then what I do is obviously I'm invested in my strategy along with our other investors. And the thing that I love about it is it's almost a perfect complement to that is if you believe in the long-term prospects of the U.S. economy, equity exposures are great to have. In balance, what we do is a fantastic complement because to the point, like you can look at the Greeks and see that the correlations are really much different than equity correlations, and you could see the volatility is much lower, and you could actually point to really rational reasons why that exists is because we have cash flow and asset driven returns. which is much different than basically betting on the enterprise value of a US corporate in the equity market. So they're almost perfect complements in a lot of ways. And so I think that's one of the things that's being picked up in the institutional markets is particularly with the consultants and the pension funds. You know, they're starting to see that, and it makes a lot of sense in institutional portfolios.
That's great.
Yeah, and I think pensions also like that. We do have a lot of current yield that some of them need it, distributed now versus just kind of back-ending like a private equity investment that's got a much longer tail, maybe higher returns. But there's a lot of pensions that are, do need some kind of distributions, and for something in our fund, we offer that election that we do give kind of semi-annual distributions to LPs if they elect, so that they can get some current cash coming back to them.
So the environment sounds really positive for all of your portfolios. So what, as a final question, what keeps you up at night? What are you most concerned about when you walk in every day?
That's a good question. I think for us, the biggest thing is like, we're so convinced that resi credit is far superior than every other credit. I think to wake up and find out that there's, again, a tremendous amount of fraud that we didn't catch or notice would be kind of like an unrecoverable event. Almost anything other than that is just going to be volatility and should create opportunities. So it might be painful in the moment. It's not going to be a life ender or fund ender, the way just not realizing that your core view on your credit is wrong.
Okay.
Yeah, I think we're just worried. It is a little bit Goldilocks right now, and so we're conscious of that. And so I think we're always looking. Our business is a very data-intensive, driven business in terms of the analytics and analysis that we can do on sort of loan-level basis. And we worry about, eventually this will somewhat start to turn, and making sure that we catch that fast enough, and that we're not, it doesn't fall off a cliff like it did kind of 10, 11 years ago.
Well, I think we established it's not going to fall off a cliff,
Agreed.
given all the regulatory
But we still worry.
reform. But you still worry. Chris, what keeps you up?
I think the thing is, I worry about liquidity. I think one of the things that we do naturally is we capture liquidity premiums. That's the beauty of what we do. There's a lot of liquidity premiums available in our sector. So if you've been around long enough and you're clever and you can source that, you can solve problems, you can do things that actually can really capture liquidity premiums. There's a plethora of them in the structured finance space. It's why we all like it. And they're consistent. They're there almost very consistently. So all you need is a little bit of change, and you'll find them. But they're fleeting. And so when liquidity locks up and markets lock up, I worry about that. And it's like air. You kind of need to breathe. And if you don't have liquidity, so that's why I think the asset liability management is something that we think very, very. We're very conscious of that. That's number one. Number two, I would just say is I worry about like policy missteps. So that. Do you see things where there are, let's say, political motivations to sort of like create excesses in the mortgage market, or policy, initiatives to create excesses in risk in like the real estate markets, or things of that nature? And I've just seen it. It's happened in the past. I mean, everybody looks at the mortgage market in the early 2000s going into the crisis, and I don't know if you could say that's particularly policy driven, but there was a statement I think that came out of a previous administration that everybody in the U.S. should own a home, and I don't know if that's necessarily shelter everybody should have, right. But owning a home is a completely different privilege, and so that you got to be very careful about that, and that promotes maybe sort of unscrupulous lending to make sure that everybody gets a home, but they get it under the wrong terms, and we can see what the byproduct of that is. So I kind of worry about sort of like policy trends, and it's something that we try to pay attention to.
Very fair. Well, with less than a minute to go, I want to thank my panelists for coming on the stage, and thanking the audience as well for joining us at 8 o'clock in the morning this Thursday. Thank you very much.
Thanks.